major market move begins with uncertainty. At the start of a new market cycle, smart options traders reset their entire approach, not to predict direction, but to survive transition and position for what comes next. The early phase of any market cycle is marked by shifting volatility, sector rotation, and choppy price action. This is where most strategies fail because traders try to force clarity that doesn't exist yet. Smart traders begin the options reset by reducing risk. They cut position size, lower margin usage, and favor defined risk trades. This allows them to stay in the game while the market finds its footing. Next, they shift focus from direction to structure. Rather than guessing up or down, they use strategies that benefit from time decay and volatility changes, such as calendars, diagonals, and defined risk spreads. At cycle starts, flexibility matters more than conviction. Smart traders build optionality, positions that can be adjusted as new information emerges. Leaps, with short-term overlays and rolling structures, provide that flexibility. As the market proves its next trend, traders slowly add directional exposure and increase size. The reset phase ends when uncertainty gives way to confirmation. The option reset isn't about trading less, it's about trading smarter. Reset risk first, let structure do the work, and allow the market to earn your conviction. Thanks for joining us at optionstrading.org.